So, the Canadian government just committed $25 million to expand cargo handling infrastructure at the Port of Halifax, and this investment is specifically designed to route transatlantic shipping traffic away from U.S. East Coast ports and keep that cargo, along with the economic activity it generates, entirely within Canadian territory. The new container cranes, terminal facilities, and rail connections being built will allow shipping companies to unload cargo from Europe directly in Halifax and move it to Canadian population centers without ever crossing into the United States. And Warren Buffett, whose Berkshire Hathaway owns BNSF Railway, which moves substantial intermodal container traffic across North America, just issued a statement about what happens when trade infrastructure investments deliberately bypass existing logistics networks that American companies have built their business models around. It's honestly hard to believe that a relatively modest $25 million investment could trigger such significant shifts in maritime shipping patterns, but when you understand the geography of Atlantic shipping routes and what Buffett said about the vulnerability of infrastructure-dependent business models, you'll see why this matters for U.S. port cities from New York to Baltimore that depend on Canadian cargo volumes to justify their operations. The announcement came last week from the Canadian Federal Transport Minister, who described the Halifax port expansion as part of Canada's national infrastructure strategy, focused on capturing a larger share of transatlantic trade. The $25 million will fund installation of 2 Super Post-Panamax container cranes capable of servicing the largest container ships currently in operation, expansion of the existing container terminal to handle an additional 200,000 TEUs annually, that's 20-foot equivalent units, the standard measurement for container capacity, and upgraded rail connections that allow loaded containers to move directly from ship to train for immediate transport to Montreal, Toronto, and other Canadian markets. Now, to understand why this matters, you need to understand the geography and economics of transatlantic shipping. Halifax is positioned approximately 800 miles closer to major European ports than New York or Boston. That geographic advantage translates to roughly a day and a half less sailing time each direction. For shipping companies operating large container vessels that cost hundreds of thousands of dollars per day to operate, that time savings is significant. A container ship that can make one additional round trip per year because it's using Halifax instead of New York generates millions of dollars in additional revenue for the shipping line. Historically, despite this geographic advantage, Halifax captured only a fraction of Canada-bound cargo from Europe. Most of it went to U.S. ports, primarily New York, Newark, and Boston, and then got trucked or railed north into Canada. This pattern existed because U.S. ports had better infrastructure, more frequent service, greater cargo handling capacity, and established logistics networks. Shipping lines found it more efficient to use the larger, better-equipped American ports, even if it meant slightly longer ocean voyages and then overland transport into Canada. The Halifax investment is designed to change that calculation by installing modern container cranes that match or exceed what's available at competing U.S. ports, by expanding terminal capacity to handle larger cargo volumes, and by ensuring direct rail connections that allow loaded containers to bypass road transport entirely. Canada is making Halifax competitive on efficiency and cost, not just on geographic proximity. The investment removes the infrastructure disadvantages that previously made U.S. ports more attractive, despite Halifax's location advantage. Let me be specific about what this new infrastructure actually is. The 2 container cranes being installed are manufactured by ZPMC, the Chinese company that produces most of the world's large port cranes. Each crane can lift containers weighing up to 65 tons and can reach across vessels 24 containers wide, the largest container ships currently in service. The cranes cost approximately $14 million each, which represents the bulk of the $25 million total investment. These aren't incremental improvements to existing equipment. These are state-of-the-art machines that will make Halifax capable of servicing any container vessel that calls at North American ports. The terminal expansion adds roughly 50 acres of paved container storage area and associated handling equipment. Container terminals need space to stack incoming and outgoing containers while they wait for onward transport. The expansion means Halifax can handle surge volumes during peak shipping seasons without experiencing the congestion and delays that plague some U.S. ports. Shipping companies value reliability. If a port can't guarantee quick turnaround times, shipping lines will route vessels elsewhere, even if the geography is less favorable. The rail connection improvements are particularly significant because they address what had been a major weakness for Halifax. Canadian National Railway already serves the port, but the upgraded facilities allow for on-dock rail loading. Containers can be lifted directly from ship to railcar without intermediate truck transport. This saves time and money, and it allows unit trains carrying only containers destined for specific inland locations to depart directly from the port facility. For cargo headed to Montreal or Toronto, on-dock rail from Halifax is faster and cheaper than unloading at a U.S. port, moving containers to a rail terminal by truck and then shipping north. Now, this is where Warren Buffett's perspective becomes relevant. Buffett's Berkshire Hathaway owns BNSF Railway, one of the largest freight rail networks in North America. BNSF operates extensive intermodal services, moving shipping containers on rail cars, including substantial traffic between ports and inland destinations. When cargo routing patterns shift, when infrastructure investments change which ports capture which traffic, that affects BNSF's business directly. Here's what Buffett said in his statement released through Berkshire. Infrastructure investments that change the competitive dynamics between transportation networks represent both opportunity and risk for companies dependent on existing cargo flow patterns. When a $25 million investment can redirect billions of dollars worth of annual cargo volume by removing efficiency disadvantages, it demonstrates how vulnerable infrastructure-dependent business models are to strategic competition. The question for companies like BNSF is whether we can adapt our services to remain competitive as shippers optimize their routing decisions based on changing infrastructure capabilities. Think about what Buffett is really saying here. He's acknowledging that BNSF's business, moving containers from U.S. ports to Canadian destinations, is now at risk because Halifax has eliminated the infrastructure disadvantages that made that routing necessary. A shipping line bringing cargo from Europe to Toronto previously would route through New York, unload there, and BNSF or another rail carrier would move those containers north. Now the same cargo can go directly to Halifax, never touch U.S. soil, and move to Toronto on Canadian National Railway. BNSF doesn't get that business anymore. To understand the magnitude of what's at stake, let me walk you through the actual economics of how shipping companies make routing decisions. A large container vessel, what's called an ultra-large container ship or ULCS, can carry 18,000 to 24,000 20-foot equivalent units. Operating costs for these vessels run approximately $200,000 to $300,000 per day, including crew, fuel, maintenance, and financing costs. Every day saved in ocean transit translates directly to reduced costs that make routes more profitable. The Europe to North America route typically takes about 7 to 9 days, depending on the specific origin and destination ports. Halifax's geographic position means that a vessel sailing from Rotterdam or Hamburg reaches Halifax roughly 36 to 40 hours before it would reach New York. On a round-trip basis, Europe to North America and back, that's about 3 days saved. For a vessel costing $250,000 per day to operate, 3 days saved represents $750,000 in reduced costs per voyage. A vessel making 20 round trips annually saves $15 million just from the shorter sailing distance. Now, shipping lines don't pocket all of those savings as profit. They operate in a competitive market where they need to offer attractive rates to cargo owners. But the cost advantage from using Halifax instead of New York gives them flexibility to offer lower rates, more frequent service, or both, which makes Halifax routing more attractive to importers and exporters. And once cargo routing patterns shift toward Halifax, network effects reinforce that shift. Shipping lines concentrate service where volumes are highest. Importers choose ports with the most frequent service. The port that captures initial volume attracts more service, which attracts more volume in a self-reinforcing cycle. The container crane investment specifically addresses what had been Halifax's major infrastructure disadvantage. Modern container ships are massive, 400 meters long, containers stacked 24 across on deck, carrying loads worth hundreds of millions of dollars. Unloading and loading these vessels requires specialized equipment that can reach across the full width of the ship, lift heavy containers quickly, and work efficiently in various weather conditions. The Super Post-Panamax cranes Halifax is installing are among the most advanced in the world, manufactured to the same specifications as the cranes at major Asian and European ports. Each crane can handle approximately 30 to 40 container moves per hour under optimal conditions. With 2 cranes working simultaneously on a single vessel, Halifax can unload or load 60 to 80 containers per hour. A large container ship might have 2,000 to 3,000 containers to discharge at a single port. At 70 containers per hour with 2 cranes working, that's roughly 30 to 40 hours of crane time to work the vessel. Add time for vessel positioning, crane setup, and other operational requirements, and a container ship might spend 48 to 60 hours in port. The faster this process happens, the more attractive the port is to shipping lines trying to maximize vessel utilization. The terminal expansion and rail connections work together to ensure that cargo doesn't create bottlenecks after being unloaded from vessels. Container terminals need enough space to stack containers while waiting for pickup by truck or train. Insufficient storage area creates congestion where containers block access to other containers, slowing down operations and creating delays. The 50-acre expansion Halifax is undertaking provides buffer capacity to handle volume surges during peak seasons when multiple vessels might arrive in close succession. The on-dock rail capability is particularly transformative for containers destined to Montreal, Toronto, and other inland Canadian markets. Currently, containers arriving at U.S. ports bound for these Canadian cities get unloaded from vessels to the terminal, then loaded onto trucks for short-distance movement to a rail terminal, what's called drayage in the industry, then loaded onto trains for the longer journey north. Each of those steps involves handling costs, time delays, and coordination challenges. On-dock rail eliminates the drayage step entirely. Containers go directly from ship to rail car, reducing costs and transit times. The scale of potentially affected cargo is substantial. Canadian imports from Europe run approximately $75 billion annually in total trade. Obviously, not all of that moves in containers, and not all of it comes through East Coast ports. But industry estimates suggest roughly $15 to $20 billion worth of European cargo destined for Canada currently flows through U.S. ports and then gets transported north. If even a quarter of that volume shifts to Halifax because of the improved infrastructure, that's several billion dollars in cargo that will no longer move through U.S. facilities and on U.S. transportation networks. It's honestly hard to believe that port authorities in places like New York and Boston didn't see this coming. But the reality is that U.S. ports have been dealing with their own infrastructure challenges and may not have fully appreciated how vulnerable they were to Canadian competition. The Port of New York and New Jersey has spent billions raising the Bayonne Bridge to accommodate larger vessels and dredging channels to handle ships with deeper drafts. Boston has struggled with aging infrastructure and limited space for expansion. Both ports face labor costs and regulatory requirements that make operations more expensive than at Canadian competitors. For the Port of New York and New Jersey specifically, Canadian cargo represents a meaningful percentage of total container volume. Estimates range from 12 to 18% depending on the season and what you count as Canadian destined. If Halifax captures a significant share of that traffic, New York faces not just lost revenue, but reduced economies of scale that make all operations more expensive. Port facilities have high fixed costs, the infrastructure, the equipment, the labor that gets spread across cargo volume. When volume declines, costs per container handled increase, which makes the port less competitive and can trigger a downward spiral. Let me give you specific numbers to illustrate the scale. The Port of New York and New Jersey handled approximately 7.8 million TEUs in 2023. If 15% of that volume is Canadian-destined cargo, that's roughly 1.17 million TEUs annually. The port generates approximately $200 to $250 in revenue per TEU through various fees and charges. Losing even 25% of the Canadian cargo, about 300,000 TEUs, would mean $60 to $75 million in annual lost revenue. That might not sound catastrophic for a port with a multi-billion-dollar operating budget, but it affects the port's ability to fund infrastructure improvements, maintain employment levels, and remain price competitive. The employment impacts are more severe than the revenue numbers suggest because port operations are labor-intensive. The International Longshoremen's Association represents workers at East Coast ports, and container operations require significant manpower even with modern equipment. A typical container terminal might employ 500 to 1,000 workers directly. Crane operators, equipment operators, clerks, mechanics, supervisors. When cargo volumes decline, ports reduce shifts, cut overtime, or lay off workers. A 10% reduction in container volume could translate to 50 to 100 direct job losses at a major terminal, plus additional losses among trucking companies, warehouse operators, and supporting services. These are good jobs by the standards of work available to people without college degrees. Longshoremen at major East Coast ports earn $30 to $45 per hour with benefits and pension contributions that bring total compensation significantly higher. A longshoreman working full-time with regular overtime might earn $80,000 to $120,000 annually. These are jobs that support families, pay mortgages, and fund retirements. When cargo volumes decline and these jobs disappear, the workers affected don't easily find comparable employment elsewhere. The trucking industry faces even more direct impacts. There are approximately 15,000 to 20,000 truck drivers in the New York metro area who specialize in port drayage, moving containers short distances between ports and rail terminals or warehouses. Additionally, there are several thousand drivers who handle longer haul movements of containers from East Coast ports to Canadian destinations. These drivers operate under a complex mix of employment arrangements. Some work for large trucking companies, others are owner-operators who own their trucks and contract for loads. Others work for smaller fleet operators. For owner-operators specifically, the economics are brutal. A truck suitable for container hauling costs $150,000 to $200,000. Drivers often finance these purchases over 5 to 7 years with monthly payments of $2,500 to $3,500 plus insurance, fuel, maintenance, and other operating costs. These drivers need consistent loads to cover their fixed costs and earn a living. If containers start flowing through Halifax instead of New York, reducing the available loads for cross-border hauls, owner-operators who specialized in that traffic face financial crisis. They can't easily switch to other freight sectors because specialized equipment and established relationships take years to develop. Warehouse and distribution facilities present similar stories of specialized investment vulnerable to routing changes. Large distribution centers near ports in New Jersey and the greater New York area were built specifically to serve as consolidation points for import cargo. A warehouse might receive containers from the port containing goods from multiple European suppliers, break down those containers, sort the cargo by destination, and reconsolidate it for delivery to retailers or other end customers. This process, called cross-docking in logistics industry terminology, adds value by providing flexibility and efficiency that direct ship-to-customer delivery can't match for many cargo types. Boston's situation is perhaps more precarious because the port is smaller and more dependent on niche cargo flows. If Canadian destined containers shift to Halifax, Boston may struggle to justify continued investment in container handling facilities and could see shipping lines reduce service frequency or eliminate Boston calls entirely in favor of larger ports like New York or Halifax. That would affect not just the port itself, but the entire logistics ecosystem in the region. Trucking companies, warehouse operators, distribution centers, all of which depend on consistent cargo volumes to maintain their operations. The employment implications extend beyond just the ports themselves. Port of New York and New Jersey directly employs about 400,000 people. When you count longshoremen, terminal operators, truckers, warehouse workers, and associated support services. Not all of those jobs are at risk from Halifax competition, but a 10 or 15% reduction in container volumes would translate to thousands of job losses in an industry that provides middle-class wages for workers without requiring college degrees. These are jobs that support families, pay mortgages, and sustain communities in the New York metro area. For trucking companies that specialize in moving containers between U.S. ports and Canadian destinations, the impact is more direct and more severe. This is a specialized business. Cross-border freight requires dealing with customs, different regulations, specific documentation. Companies have invested in building that expertise and establishing relationships with shippers who need reliable cross-border service. If cargo starts flowing directly through Halifax instead, that entire business segment disappears. Some companies will adapt by finding other freight to haul, but others, particularly smaller operators, may not survive the transition. Warehouse and distribution facilities near U.S. East Coast ports that handle Canadian-bound cargo face similar challenges. These facilities were located specifically to serve as staging points for goods moving from ships to trucks or trains headed north. If the cargo flow shifts to Halifax and then moves via Canadian rail directly to Canadian distribution centers, these U.S. facilities lose business. Commercial real estate near ports is expensive and purpose-built for logistics operations. Facilities that lose their cargo volumes can't easily be repurposed, and property owners face significant losses if tenants vacate. From Canada's perspective, this investment makes perfect economic sense. For $25 million, a relatively modest sum in infrastructure terms, Canada captures economic activity that was previously leaking to the United States. Every container that gets unloaded in Halifax instead of New York generates port fees, employment for Canadian longshoremen, business for Canadian trucking and rail companies, and economic activity in Canadian communities. The cargo was always destined for Canada. The only question was whether it would pass through U.S. infrastructure on the way. The economic multiplier effects for Halifax and the broader maritime provinces are substantial. Direct port employment from the expansion might add 200 to 300 jobs: crane operators, terminal workers, maintenance personnel, administrative staff. But each of those direct jobs supports additional employment in supporting industries. Trucking companies need more drivers to move increased cargo volumes. Warehouse facilities expand to handle additional throughput. Ship chandlers and marine service providers see more business from vessels calling at the port. Restaurants, hotels, and retail establishments benefit from workers with steady employment spending their paychecks locally. Economic development officials in Nova Scotia estimate that every $1 million in port cargo value generates approximately $15,000 to $20,000 in regional economic activity through these multiplier effects. If the Halifax expansion captures even $2 billion in annual cargo that previously flowed through U.S. ports, that translates to $30 to $40 million in additional annual economic activity in the Halifax region. For a metropolitan area with a population of about 450,000, that's meaningful economic impact that supports thousands of jobs and generates tax revenue for local and provincial governments. The rail connections provide particular benefits because they tie Halifax more tightly into Canadian inland markets. Canadian National Railway operates the rail line from Halifax to Montreal and beyond. Increased container volumes from the port mean more freight revenue for CN, which supports employment at rail facilities, maintenance yards, and along the corridor. For small towns along the rail route, increased train traffic can mean additional rail employment, track maintenance workers, signal technicians, yard crews at intermediate stops. These are stable, well-paying jobs in communities that often struggle with limited employment opportunities. Canadian officials are explicit about this economic nationalism dimension. In announcing the Halifax investment, the Transport Minister emphasized that Canada should be capturing the full economic value of its international trade rather than allowing that value to flow through foreign ports and foreign transportation networks. This resonates politically in Canada because there's long-standing frustration about economic dependence on the United States and concern about ensuring that Canadian trade generates Canadian jobs and Canadian economic activity. There's historical context for this frustration. Throughout much of the 20th century, Canadian resources and manufactured goods often moved through U.S. infrastructure for export to global markets. Grain from prairie provinces would be shipped through Great Lakes ports and then through U.S. ports for export. Timber from British Columbia might move through U.S. rail networks. This pattern generated economic benefits and employment in the United States, while Canadian communities that produced the goods captured only a fraction of the total value chain. Canadian policymakers have long sought to reverse this pattern by investing in infrastructure that keeps Canadian trade within Canadian systems. The Halifax investment fits this broader strategic vision of ensuring that Canadian trade enriches Canadian communities rather than foreign ones. It's not anti-American in the sense of being hostile or adversarial. It's pro-Canadian in the sense of pursuing Canada's economic self-interest. From the Canadian government's perspective, investing $25 million to capture billions in economic activity and thousands of jobs is simply smart economic policy, regardless of whether it creates challenges for U.S. port cities. There's also a sovereignty and security dimension that Canadian policymakers consider. Depending on U.S. ports for critical imports creates vulnerability to American political decisions or operational disruptions. If labor strikes shut down U.S. East Coast ports, Canadian importers can't get their goods even though the cargo is destined for Canada. If U.S. security requirements create delays or restrictions, Canadian commerce suffers. If political tensions between the U.S. and Canada lead to border complications, cargo flow becomes uncertain. Having robust Canadian port infrastructure reduces these dependencies and gives Canada more control over its own supply chains. The COVID-19 pandemic reinforced these concerns about supply chain resilience and dependency. When border crossings faced restrictions and delays, when U.S. ports experienced congestion and backlogs, Canadian importers relying on those routes faced significant challenges getting critical goods. Medical supplies, food, manufacturing inputs all experienced delays because Canadian supply chains depended on smooth functioning of U.S. Those experiences created political momentum for infrastructure investments like the Halifax expansion that reduced dependency on foreign facilities. For shipping companies, the actual customers for port services, Halifax's improved capabilities create options they didn't have before. Shipping is an intensely competitive business operating on thin margins. Companies are constantly optimizing routes, port calls, and schedules to reduce costs and improve efficiency. If Halifax can offer comparable service quality to New York or Boston with a day-and-a-half time savings each direction, many shipping lines will choose Halifax for Canadian cargo. The decision isn't political or emotional, it's purely economic optimization. The decision-making process at shipping lines involves detailed analysis of total delivered costs, not just ocean freight, but the entire door-to-door logistics chain. For cargo destined to Toronto, a shipping line compares the cost of sailing to Halifax and then moving containers by rail to Toronto versus sailing to New York, unloading there, and moving containers north by truck or rail. The Halifax route has a shorter ocean voyage, lower fuel costs, faster vessel turnaround, but might have slightly higher inland rail costs if Canadian rail rates exceed U.S. rates. The shipping line runs the numbers for different cargo types, different volumes, different seasonal patterns, and chooses the routing that delivers the lowest total cost. What the Halifax infrastructure investment does is ensure that port costs and efficiency don't disadvantage the Canadian route. Previously, even with the geographic advantage, Shipping lines might choose New York because faster crane operations or better terminal efficiency offset the longer sailing distance. Now, Halifax matches New York on infrastructure capability, which means the geographic advantage becomes the decisive factor. Unless U.S. ports can offer overwhelming advantages elsewhere in the logistics chain, the shorter sailing distance makes Halifax the rational economic choice for Canadian-destined cargo. Several major container shipping lines, including Maersk, MSC, and CMA CGM, have already indicated they're evaluating expanded Halifax service based on the infrastructure improvements. These companies operate vessels that cost anywhere from $100,000 to $300,000 per day to run. Saving a day and a half per voyage through geographic routing translates directly to their bottom line. If the infrastructure can handle their vessels efficiently, they'll use it regardless of whether it helps or hurts U.S. ports. Shipping lines are businesses, not foreign policy instruments. They serve the routes and use the ports that maximize their profitability, and Halifax's infrastructure improvements make it a more profitable choice for Canadian cargo. The timing of this investment is also strategic. Global shipping patterns are in flux following pandemic disruptions, shifts in trade relationships, and changing vessel sizes. Many shipping lines are reassessing their North American port strategies. Halifax is positioning itself to capture a larger share of these revised routing decisions, while companies are already reconsidering their networks. It's easier to shift to Halifax when you're already revising your entire North American schedule than to change an established routing pattern that's working adequately. There's also a climate and environmental angle that advantages Halifax. Container shipping faces increasing pressure to reduce emissions, and shorter ocean voyages mean less fuel consumption and lower emissions. Shipping lines trying to meet sustainability targets or respond to customer pressure for greener logistics can cite the geographic efficiency of Halifax routing as part of their environmental initiatives. This creates additional incentive to shift traffic beyond just the economic calculations. For U.S. port cities, the question is how to respond. Simply matching Halifax's infrastructure investment won't eliminate the geographic advantage. New York will always be 800 miles farther from Europe than Halifax. U.S. ports need to compete on service quality, reliability, connectivity to inland markets, and total logistics costs. Some of this is within port authorities' control through infrastructure investments and operational improvements. Some of it depends on factors like labor costs and regulations that individual ports can't easily change. The Port of New York and New Jersey is investing in automation and efficiency improvements designed to reduce vessel turnaround times and handling costs. If they can unload and reload ships faster than Halifax, that partially offsets the geographic disadvantage. Boston is exploring specialized cargo niches where it might have competitive advantages, certain refrigerated cargo, oversized freight, or time-sensitive shipments where specialized handling capabilities matter more than pure geographic efficiency. But there's a limit to how much U.S. ports can do to counteract a fundamental geographic reality. Halifax is closer to Europe. Infrastructure improvements that bring Halifax to parity with U.S. ports on handling capability mean that geographic advantage becomes decisive. Unless U.S. ports can offer overwhelming advantages in other dimensions, rational shipping companies will choose the shorter voyage when the service quality is comparable. The broader implication is about how infrastructure competition between countries shapes economic activity and employment. For decades, Canadian cargo flowing through U.S. ports represented a kind of geographic subsidy to American logistics infrastructure. Canada's imports and exports helped justify the scale of U.S. port operations, generated business for U.S. transportation companies, and created American jobs. That arrangement persisted not because of any formal agreement, but because U.S. ports offered better infrastructure and service. Now, Canada is investing strategically to recapture that economic activity. The $25 million spent on Halifax infrastructure shifts potentially billions of dollars in annual cargo volume and thousands of jobs from the United States to Canada. That return on investment is remarkable and demonstrates why countries compete on infrastructure. Relatively modest strategic investments can redirect large economic flows when they address key bottlenecks or competitive disadvantages. For workers in U.S. port cities, this is frustrating because they have no control over these competitive dynamics. A longshoreman in New York didn't choose to be 800 miles farther from Europe than Halifax. A trucker in Boston who specializes in cross-border freight didn't create the infrastructure gap that made U.S. ports more attractive despite geographic disadvantages. But when Canada closes that infrastructure gap, these workers bear the consequences through reduced hours, lower incomes, or job losses. There's a political economy question about whether the U.S. federal government should respond with its own infrastructure investments to help American ports remain competitive. Making that case requires arguing that maintaining cargo volumes at U.S. ports generates broader economic benefits that justify public investment. That's complicated because ports generally operate as independent authorities or private facilities, not as federal government assets. Federal port infrastructure investments face questions about why taxpayers should subsidize competition between U.S. From a pure efficiency perspective, cargo flowing through the geographically closest port makes sense. If Halifax is genuinely closer to Europe and can offer competitive service, routing Canadian cargo through Halifax rather than New York is more efficient overall, less fuel burned, less time consumed, lower total transportation costs. The fact that it shifts employment from American to Canadian workers doesn't change the underlying efficiency, though it obviously matters greatly to the workers affected. The situation also illustrates how integrated North American commerce is, and how changes in one country affect the other. U.S. ports and logistics companies built business models partly around serving Canadian cargo flows. Canadian importers and exporters developed supply chains around using U.S. ports because that's where the infrastructure was best. Now that those relationships are shifting, there are adjustment costs and disruptions on both sides, even though the ultimate result may be more efficient overall. Looking forward, the Halifax investment represents the beginning, rather than the end, of Canadian infrastructure competition. If the initial $25 million investment successfully captures additional cargo volume, there will be strong political and economic pressure to invest more additional cranes, further terminal expansion, enhanced rail connections. Success breeds expansion and infrastructure competition, just as it does in commercial markets. Canada will want to maximize its advantage while momentum is favorable. U.S. ports need to recognize they're in an ongoing competition that won't be won once and permanently. Maintaining competitiveness requires continuous investment, operational improvement, and responsiveness to shipper needs. The ports that thrive will be those that can demonstrate clear value propositions, whether through specialized capabilities, superior service, better inland connectivity, or other advantages that offset geographic disadvantages where those exist. For Buffett and Berkshire Hathaway, the Halifax situation reinforces lessons about infrastructure-dependent businesses. BNSF is a phenomenally profitable railroad with strong competitive positions in many markets, but movements in cargo routing patterns driven by infrastructure investments elsewhere create risks that even strong competitive positions can't fully protect against. The statement Buffett issued isn't predicting disaster for BNSF. It's acknowledging a vulnerability and signaling that the company needs to remain adaptive and responsive to changing logistics patterns. So here's where we are. Canada has invested $25 million in Halifax port infrastructure, specifically designed to route European cargo directly to Canadian markets without passing through U.S. ports. Warren Buffett has acknowledged that this represents a competitive threat to infrastructure-dependent businesses like BNSF Railway that built models around existing cargo routing patterns. The infrastructure being installed, modern container cranes, expanded terminals, enhanced rail connections, eliminates the service quality disadvantages that previously made U.S. ports more attractive despite Halifax's geographic proximity to Europe. This matters because billions of dollars in annual cargo volume that currently flows through U.S. East Coast ports may shift to Halifax, reducing business for U.S. ports, rail carriers, trucking companies, and warehouse operators. Thousands of jobs in U.S. port cities depend on cargo volumes that include Canadian-destined freight. When that freight shifts to Canadian routing, U.S. workers and communities lose economic activity that supported middle-class employment. From Canada's perspective, this is strategic economic policy, capturing economic value from Canadian trade that was previously flowing through foreign infrastructure. From the U.S. perspective, it's competition that threatens established industries and employment in port cities. The outcome will depend on how shipping companies respond to Halifax's improved capabilities, how U.S. ports compete on service quality and efficiency, and whether the geographic advantages of Halifax prove as decisive as Canadian officials expect now that infrastructure disadvantages have been addressed. What's certain is that infrastructure competition shapes where economic activity happens and who benefits from it. A $25 million investment may not sound massive in the context of multi-billion-dollar trade flows, but if it successfully redirects cargo routing patterns, it demonstrates the leverage that strategic infrastructure improvements can achieve. U.S. port cities now face the reality that geographic advantages they've been competing against for years are being reinforced by Canadian infrastructure investments specifically designed to exploit those advantages. How that competition plays out will determine the distribution of maritime logistics employment and economic activity along the eastern seaboard for years to come,